We're live, man. What's up, B? How you doing, bro?
Oh man, I'm blessed, man. I'm blessed. You?
I'm doing great. Thanks, man. It's good to be
What's
here.
up? It's always good to be here.
I think we discovered something right now. We've been sipping on these
Sipping
pumpkin
on these pumpkin spice,
pumpkin.
nitro,
Yep.
nitro brewed. Yeah, bro. It's a different level. That's a different level for coffee. You know, I'm no coffee connoisseur, but
Absolutely.
that's quite addictive.
Right. So yeah, we're high on caffeine right now, man. I wanted to talk to you today about risk buckets, capital risk buckets. So in Investopedia, the term bucket, it's like a business and finance term to describe like a grouping of related assets or categories.
Correct.
And but we, looking at multifamily and the whole nine, there's a certain way that we should go about looking at buckets as well, right?
Yeah, certain way of evaluating risk.
Right,
Absolutely.
exactly.
Absolutely.
Exactly. So I wanted to see if you could tell us more about that. Like, so how are you looking at, how do you break things down into buckets and put things into places where, evaluating deals, whether they're good or not. So maybe you can explain it in your own terms, just like,
Yeah.
how do you go about it?
And I think one of the things that's good about, Bryan Chavis,
Yep.
as speaking as in third.
Hey.
Was that third person?
Third person.
Speaking in third person. I think one of the things that's good about me is that I'm consistent.
Yep.
When you're asking me about risk buckets, it's really you're asking me about the COTA process. So if you open up my book, you're going to see the COTA process, strategic evaluation of a target area, and you perform that to really be able to kind of really identify certain markets that you're interested in and look at the various different risks involved with certain areas. And an example of that, excuse me, my allergies are killing me today,
it's okay.
but examples of that is, you're looking to invest in areas where it's very transient, low income, moderate income neighborhoods.
Right.
That offers a certain level of risk, but it also there's a certain level of reward there as far as the returns should be greater, cap rates should be higher. There's risks, typically associated with with those assets, less risks associated with assets that are in core markets, core plus markets. And then the risk kind of shifts towards the actual building itself, not the actual market that it's located in. That's typically secure when you're talking about a core plus market. So it's insulated by good employment, great economic drivers and demographic drivers. Then the risk shifts to the actual building itself, nuts and bolts, bricks and mortar.
Right.
So it's just being able to understand how to weigh those risks, and then as a syndicator to be able to relay that to the investor so they understand, hey, look, investing is just not a broad brush stroke. If you want to go in this market or that market, and typically the syndicator or the general partner is the one guiding the ship.
Right.
That's the good thing about being the general partner or the sponsor, however you want to define that individual, is really taking the horse by the reins, the individual driving the ship.
Yep.
Is they kind of choose the markets, but you still have to relay your message and your core message,
Correct.
And that's why at Chavis Capital we kind of just show you a broad brush stroke of these are all the type of buckets,
Right.
No matter what bucket we enter into, these are the type of risks that you should that are typically associated with this bucket. These are the returns associated with the bucket, and of course, higher the risk, higher the returns. And then you just, of course, you have to do a good job of defining to your audience that you have a full grasp of the situation, that no matter what you enter into, you're kind of like for us, I'm a Swiss Army knife.
Right.
You can drop me off anywhere, and, I'm going to be able to operate and manage the asset at the end of the day. And that's what you got to really have to convey to your investors, is that no matter which direction we go into, we have it. We have a solid business plan in place. We have a solid management plan in place. We have the personnel to be able to do what we need to be able to execute, and really that's kind of the 10,000 square foot view. We can always obviously drill down deeper about the COTA process and what's involved in that, but at a 10,000 square foot view, that's kind of the answer.
Hey, that makes sense, man. So no, I wanted to just kind of put it into like a real world breakdown. So we find ourselves getting approached by investors all the time, and they're eager to invest. I think we looked at a property recently, just the last week.
Every week.
This one was on the coast, full of weekly rentals. As soon as they said the price, you got up and walked out.
Yeah. I didn't mean to be rude, and that was rude.
It's all right.
But
that wasn't a bucket you wanted to deal with.
It wasn't a bucket I wanted to deal with. But you must send a message. And during that property tour, the lady had already rubbed me wrong a couple of ways. Yeah. Lying about the income. So when you set a price, number one, you're overpriced. But when you set a price, I don't mind you being overpriced because it's all emotions. You think your property's worth X, Y, and Z. The bank thinks it's worth X, Y, and Z. Bank's always going to underwrite based on net operating income. So they're typically, they're the ones that are always going to really tell you what the property is really worth.
Right.
Based on the income. But again, knowing that, you also have to realize that based on the income, is typically based on the operator. So if there's low income on the property, it doesn't necessarily mean it's the property's fault. It could be the operator's fault, like in the case that you're talking about when we were on St. Pete Beach.
Yep.
It wasn't the case of the property itself because the income was so low and the asking price was so high. It was the income was low because the operator wasn't operating the property correctly.
Right.
But when you're lying about your profit and loss, your P&Ls, anybody watching, they're talking about your T12s, and you're lying about the income that you produce. And I do because I have obviously I wrote the book on it.
Right.
And the one thing about me is that I just don't sit around and write books and bang out books and throw them up on Amazon and self-publish.
Right.
And kind of, and sit back, on writing books and creating training programs. This is what I do for a living.
Correct.
You can't sit there and tell me, this is the kind of income you're drawing from your laundry machines when I got laundry machines at my property and I know how much I'm pushing. I know the revenue.
Right.
I can whip out a P&L and show you, hey, listen, lady, you were talking about getting $1,700 a week. We both have washer and dryers. How much are you charging for that, for that one cycle? $8 a cycle? Yeah, I know I charge $1.25 for for my tenants coin laundry. You're making $1,800 a week. You must be charging $20 a cycle.
Right.
Put that sucker in for a 10-minute drive. Boom.
Yep.
$20.
Yep.
That's what to me. It's like you have to be charging those numbers, and we know that's not the case. So we know you're inflating. And then when you sit at the table, and we begin to negotiate like we did over lunch, and you come up with this inflammatory asking price, I got up. I let Joe and whoever was there, let them guys, I got up. At the end of the day, I heard all I needed to hear.
Right.
It's like, oh, I'm firm on that. When you were like, oh, I'm firm, I got up. Sent a message.
Yep.
For me, negotiation, you don't get paid what you're worth. You only get paid what you negotiate. And for me, negotiation is a game of chess. It's not checkers. And so, when the person sees me get up, and you notice, and you've been there, tons of times, I don't do any talking.
Correct.
It's like I say I say the least amount of words.
Right.
When we're on site and I ask certain questions, and when you see me engage, it's never engaging with the broker. I'm never engaging I'm always engaging with the property manager on site. That's the individual that I want to talk to. But when we're negotiating, you'll see I'm never really talking.
Yeah. No, you were spending time. I know you were talking into your phone and kind of
taking notes,
and scoring the property.
Scoring the property.
Yep.
But I purposely don't really engage in conversation.
Yep.
Because I'd rather you learn more by listening than you do talking. Anytime you're talking, you're doing less listening. That's
true.
And for me, I'm just trying to fact find and gather information. And the more you give people rope, and the more you allow someone a soapbox to speak, or and give them put a microphone in front of them, the more they're going to speak, and the more they speak, the more they kind of tell a story. And for me, it's when you're sifting through this, I'm just listening for the story because I know what it takes to operate these properties. You can't fool me. This is what I do. This is all I've ever done, for a living is multifamily. This is where we're a little different than a lot of the gurus and experts. You can check my resume, you know, I was leasing apartments at 20, 21, right. 22. I started in this industry. This is all I know. So you can't sit there and tell me this is what we do operational. This is what we get. This is what our expenses are. You can't fool Bryan on that. I mean, if you want a certain price, just ask for it. If it's, if it's inflated, I'll tell you it's inflated. I'll get up from the table. But yeah, at the end of the day, I'm there to kind of just score the property. And then at the end of the day, we'll just fire an LOI based on, our facts. And if you notice too, that was an unsophisticated seller.
Right.
Though she thought she was sophisticated, she was very unsophisticated in her approach, at least, on how she, arrived to her asking price.
Right.
Then we had another deal, 138 units in St. Pete, that was put on the market by a professional brokerage. I won't name any names, but this is one of the largest commercial brokers in the world.
Correct.
Same thing. Put a property out, and I thought it was overpriced. And with those guys, I send them my model. So I send them the Chavis Capital underwriting model. By the way, that's on sale. Anybody can pick this model up. But so I send them the model, and my job is to say, hey, look, they wanted 18. I told them it's worth 16.5.
Yep.
It's worth 16.5 based on the offers or based on the prefs, the returns that I can give our investors in the waterfall structure that we have in place, which is a sound. It's a fair asking price,
right?
A fair offer. But the 18 was well, inflated. And so what I do is I push back and say, hey, look, here are the property taxes. Your property taxes were on your offering memorandum were inflated. Or I mean, underpriced. You're saying we're going to get X on property taxes when we knew it was probably 15 to 20,000. There was a variance. I don't want to go too far into that variance. I don't want to call anybody out, but there was a gulf between what we knew the property taxes would be and what they had advertised.
Right.
And so there was a lot of discrepancies and things of that nature. But at the end of the day, this is what it's worth. And what I do is I just send those individuals the model and say, hey, listen, show me where I'm wrong in my underwriting, and then we can have a conversation. Left it at that. No love lost, no issues. Hey, look, this is what I can pay for. This is what I'm willing to do.
Correct.
And you notice they came back. And they were like, hey, look, a week later, let's have a conversation. We're willing to come down to maybe, could you come down to 17.5? No, but you guys are moving in the right direction.
Exactly.
Call me next week if you're still willing to if you're still willing to come down on the price. But at the end of the day, they came back. So, you really just have to stick to your guns and understand, this is, you're going to win. So you're going to lose a lot more than you're going to win. Yep. But you're just trying to really, you have to protect you have to protect, those, going back to those risk buckets and being able to say, hey, this is what I can provide you as an investor. If you invest in my deals and my projects, this is what I can do. This is how I can perform.
Exactly.
And we already have built-in buffers. So if something should happen to the economy or the market, we kind of still feel we can reach these numbers. But if you start getting a little bit too far over your skis, and you start paying some of these asking prices because you're eager to get involved and get this thing going, this thing meaning your business, your portfolio, your syndicating business, mistakes can happen. And the one thing, Nate, I'll say is a lot of people haven't really, but a lot of people haven't experienced what it's like to operate multifamily in a bad market. Yep. It's been, a lot of people been, the low tide we haven't had a low tide.
Correct.
But when the low tide does happen, you're going to see a lot of individuals swimming naked. There's going to be a lot of individuals who posture themselves as experts and gurus that really haven't, just because you are able to buy a property, put together a syndication, buy a property, doesn't necessarily mean you're an expert. A lot of the so-called experts also rely third party on property managers to operate their properties.
Correct.
At the end of the day, and that's fine. I'm not knocking into that, but I'm just simply saying, it doesn't necessarily make you an expert because you can underwrite and put a deal together and raise money, raise capital, and go out and find deals. Doesn't necessarily make you a complete, operator. At the end of the day, at the day-to-day operations is the most important part of the investment. So a lot of these guys, when you see the market change, and the markets always change, and you're starting getting to a softening in rental prices, and you start to see cap rate decompression. start to see values maybe taper off a little bit. You're gonna, vacancies rise. Some tough times ahead, some headwinds to come. You get to really see who understands the multifamily industry when you're able to position your property and you're able to buy, anticipating certain headwinds, and understanding how those headwinds are going to affect you at the operational level. Your property managers is, that's when you're going to really start seeing, really who knows what they're talking about or who's just, on social media.
Yeah.
You know what I mean? Hollering about being an expert or a guru.
Exactly. No, that makes sense, man. Fast forward to, a week after we went to go look at that property, the investors start calling. We get the calls from the investors. They see the live streams. They see us out on the properties. One guy, said, hey, tell me about that, that $5 million property, and he started reeling off numbers and he had it all figured out.
Mm-hmm.
I was like, why did you guys walk away from that? I would have jumped on that. Like, let's bring that back on the table. He's not evaluating the risk buckets.
Well, because a fool and their money are quickly departed.
That's correct.
And I'm not calling anybody a fool. I guess I am calling somebody a fool. A fool and their money are quickly departed.
Mm-hmm.
It's not a deal. And based upon the way we underwrite, based upon the CIOTA strategic evaluation of a target area, based upon the process that I have set up to pick out certain markets and certain projects, if no matter how good it looks, if it doesn't fit within those parameters, then we have to walk away because I'm factoring in risk, I'm factoring in headwinds, I'm factoring in things that could come because I've been through it,
right.
I've experienced it at its worst in 2008, and so I understand. And I've experienced it when I worked in the multifamily industry. I worked in some very tough markets, man, tough markets, low income, moderate neighborhoods. Tough transient markets. And I understand how you have to navigate, how you have to create net operating income. And at that point, net operating income is really 85% based upon operations, your
Correct.
ability to collect, your ability to evict quickly, efficiently.
Right.
Your ability to then release quickly,
So talk about that for a sec, B. So I want you to explain to me, like, what does it look like in a bad market? Not necessarily how you turn things around, but I want people to know, like, okay, yeah, things are good. You got money, you got good credit, you snatching up apartments left and right, you're syndicating with people, everything sounds good. You're riding this gravy train. The market turns.
Right.
What does that look like, man?
Well, what does it look like when a market turns?
What are some of the downfalls, man?
Well, the headwinds are the good thing is that you have to learn how to read the tea leaves. So a really good operator is already going to kind of understand that it's coming. Mm-hmm. They read tea leaves. They look at the Wall Street. They look at interest rates. They look at unemployment statistics. You know what I mean? They see softening in the market in certain areas in retail. You get to be able to kind of see certain things happen before it really hits you. There's always a 5-month lag period typically, right, to allow you to kind of prepare and get ready for it. But for the most part, it's a hit on your net operating income.
Okay.
When you're talking multifamily, it's a point where your ability to increase rents at the end of renewals is stymied.
Okay.
And you'll hear talk of tenants moving out and saying, "Hey, look, I love being here. However, this person is offering 1 month free rent.
Right.
No waiving security deposit." That's when by then you're already in the ring with Mike Tyson. By then it's just kind of too late to kind of draw up a game plan.
Correct.
You just kind of have to, you know what I mean, and take the hits.
Take the hits.
And hope to God you can go down on one knee and
right,
you kind of, you know what I mean. But you're already in the ring with Tyson. The smart operator is going to realize, okay, Tyson is coming. I got to fight. I need to train a certain way. I need to train my staff a certain way. I need to be able to get control of operating expenses. I need to be able to make sure my team knows how to lease in hard times. The thing is, everyone can lease apartments in good times.
Absolutely.
They're hardly shown. I mean, right?
Right.
We're just being real on that.
Yeah. No, be real, bro.
On By the Block
podcast.
Exactly.
There you go.
I mean, everybody looks good as an all-star leasing agent or all-star real estate professional, leasing apartments and when the market is good and there's demand. But when there's not demand and there's competition, and then the Class A properties are offering all these discounts, and you're competing with Class A properties that have these amenities like gyms and saunas and movie theaters, and they're Now we'll get to see who. Now we get to see who's really an operator. You know, have you prepared your staff? You know, to lease in those conditions when you have a, you know, you might have like me a Class C type asset in a core Class A, you know, market.
Correct. Yep.
You know, do you know how to position that marketing wise? Do you know how to set people up on tours? You know. Now you can't just open up the door and say, hey, look, here's my unit, and sit back and jump on your phone and start talking while they're looking through the unit. Now you have to be able to sell something.
Yep.
Get a deposit.
Yep.
Now you have to actually work. So, you know, the ability to making sure that your staff and team understands how to work and understands how to read those tea leaves is really instrumental in being a successful multifamily operator. You don't want to be reactive. You want to be proactive. You lose money when you're reactive.
So it sounds like, I mean, that's more sophisticated than just looking at the cap rate,
Oh,
which
yeah.
is all I was hearing from the guy when he called. It's like, oh, you can get a X cap on that property, man. X cap. I was like, bro, you didn't see the weekly people renting at this.
But here's the thing.
Yeah.
Where does the cap rate arrive? Again, people are quick to use formulas because
Absolutely.
they regurgitate what they've heard in a boot camp or a training or
Yep.
on YouTube or whatever. They get the information. Google.
Yep.
You know, the biggest instructor out there, Google. You just
Yep.
Google whatever you want. You know, it's cap rates. But do you what? How do you arrive to a cap?
Right.
Net operating income divided by the value of the asset. The value of the asset can be subject to opinion.
True.
But the net operating income should not be subject to opinion. The net operating income is the net operating income. So therefore, you know, drill down. It's not necessarily just the cap rate. It's also about that net operating income. What makes up net operating income typically on these properties? 99.9% of net operating income typically arrives from rent.
Yep.
Who pays rent? People.
Yeah.
Not brick and mortar. People pay rent. So really understanding who your people are, who your prospect tenant is, understanding demographics and psychographics, going back to the COTA process now.
Correct.
Everything is going to always come back to my fundamentals. You'll never be able to, you know, you can't catch me in an interview and catch me slipping. It's always going to come back to fundamentals and understanding how to, you know, be rooted in your fundamentals in the multifamily industry, you know, at the end of the day.
So, I mean, these are things, so I'm not you think, but so you're seeing all these people making these promises and anything can go south if they haven't evaluated their risk and they haven't even evaluated the market.
Well, anything can go south even if you have evaluated correctly.
True.
I've evaluated correctly when things went south.
Correct.
Mike Tyson, you know, no matter what, you can train for Mike Tyson, but when you actually get hit by him, all that training goes out the window. It still hurts.
Exactly.
You know what I mean? You still get dropped to one knee, if not knocked out cold.
Right.
So, you know, you can evaluate and train all you want and still get knocked out.
Right.
But the idea is, you know, you want to be able to go the distance.
That's right.
You want to be able to at least have the ability to counterpunch. Take a hit and counterpunch in markets. And the counterpunchers are the ones who have studied the market and who have fallen back strongly on fundamentals.
Right. Okay. Man, so evaluate your risk, you know, make sure you segment things out into those buckets and, you know, don't just go off of hearsay from what people, you know, throwing out there as far as,
you know, do your homework.
You Yep.
They're not an advisor. They're a salesperson or an advisor. Those are the two type of people that you're going to be dealing with. Advisors want to make money with you.
Exactly.
Salespeople want to make money from you. It's a big difference. So anyone who wants to make money from you, you got to understand there's a huge agenda in place. So you got to kind of sift through that agenda. And that's why you look at and do your homework and do what they call underwriting and your due diligence, because you got to sift through that, through all the smoke and mirror and all of the, the bells and whistles that come along with these properties and be able to kind of get to the heart of it, the net operating income, and really get to the heart of value.
Hey, man. Hey, Bryan, thank you so much for all these nuggets of wisdom, bro. I appreciate it, man.
That's what we do here on By the Block.
By the Block.
As well as give Starbucks free promotion. They need to start feeding us these drinks for free, bro. We're here. You know,
I think we're overloaded on pumpkin spice right now.
Overloaded on pumpkin spice. So you got me. Yeah. We're not sipping on Crown Royal here in the studio. We're sipping on pumpkin spice, dropping knowledge. So
adult life.
Adult life, yeah.
Man, well, yeah, once again, thank you so much. And you guys can follow Bryan at bryanchavis.com. Once again, that's bryanchavis.com. Just always be able to see what he's up to, man. Thank you so much for being in the studio, brother.
Yeah, absolutely.
And looking forward to continually buying the block with you, man.